Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we kick off this week in a very different tone than where we were when we met last week. Last week, the markets were full of optimism, inflation prints coming out better than expected, uh, Trump softness in terms of tariff policy, uh, just general optimism around deregulation and tax cuts going forward really propelled the S&P 500 to new all-time highs at the end of last week. And opened up Monday morning. We open up to a very different world with news out of China's DeepSeek AI chatbot seemingly, at least on the AI benchmarks, exceeding some of the leading models out of OpenAI from ChatGPT, where the training of it was, or the cost of the training or development of it was at a small fraction of the price that we know that ChatGPT or Gemini or Grok were trained on, and they made a completely open source, open weight AI chatbot that anyone can have access to. And that really sent some shockwaves around the world over the weekend, sent stocks like Nvidia down nearly 20% here yesterday, wiping out over a $500 billion in market value. And just Nvidia alone, we lost more than $1 trillion in equity valuations on yesterday. I think the largest single day decline in equity valuation in the history of the US stock market. So some serious changes in terms of tone yesterday. And I think a lot of investors like you are probably asking yourselves, how does this actually affect our outlook going forward? Um, and how do we think about navigating this? And it is still at the moment a little too early to tell as to whether or not the news out of China with DeepSeek is truly genuine in terms of the numbers that were presented. The number that was presented was that they managed to effectively create a industry leading AI model for the cost of around $5 million versus, we know that OpenAI, Grok, Gemini have spent, well over $100 million each towards building their leading models. And at least in the benchmarks, DeepSeek seemingly was beating out even kind of the leading model at the time, which was ChatGPT's O1 and O3 models. Now, I will say, this is really kind of number one, there's a difference between benchmarks and real world applications. And I think if anyone's had the opportunity to use DeepSeek, and I certainly have over the past uh, I've used it quite a bit over the last 24 hours, and I've used it a lot over the last week or so. I think anyone who's actually used it can see that DeepSeek, from a practical usage application perspective, is light years behind the leading models of ChatGPT in terms of features and usability. It might beat out O1 and O3 models from a reasoning perspective. And even that, I think, is somewhat questionable in terms of that particular claim. Um, but the big claim that really moved the markets is not necessarily how good the models are, even though that is certainly an important element. What really moved the markets yesterday was the supposed cost of what it cost them to build it, using far inferior chips to what OpenAI, Gemini, and Grok have access to. The NVIDIA's latest chips. They claim to have built these models uh, on more inferior chips at a fraction of the cost. And I think that is going to be the part that's going to be hotly debated here over the next few days, next few weeks, as to what was the true cost or what was the true work behind the scenes to actually get this work done. Is this a bit of a way to kind of get back at the US in regards to some of the, call it the trade wars between US and China, and this is one way for China to fight back? Or are these results actually true? Because if the results are true in terms of the cost, that will have significant ramifications on you know, how much investors will accept these large tech companies can continue to spend on their build outs to dominate in the AI space. I think investors were already, prior to this news, jittery about how much tech companies have said that they were committed to spending on building out AI infrastructure. Microsoft came out just a week or two ago saying that they're going to spend north of 50 to 60 billion dollars this year. Meta spending out more than 60 billion dollars. Alphabet not far behind. We know Oracle with the Project Stargate that Trump announced last week was planning on spending tens of billions of dollars. OpenAI alongside with that, and a lot of that spend was going to go towards Nvidia, which is why Nvidia took it on the chin yesterday, nearly 20% down, $500 billion in market cap wiped off because there was some serious concerns at the start yesterday as to whether or not these commitments, of tens of billion dollars to spend in 2025 and 2026, were going to potentially be scaled back if it truly were. Models that were able to be created that, beat the leading models at a small fraction of the cost. So, that just helps, I think, for investors who perhaps are a little bit confused as to how we had such a strong, violent sell-off in, big names like Nvidia and a lot of these ancillary stocks around um, uh, build out of data centers, why they took such a big move yesterday, it really comes down to that. And it's too early to tell as to whether or not the numbers out of DeepSeek are true. And I don't necessarily know that we'll ever know the true facts, but I think, investors yesterday at the morning were very much um, decided to sell the news and figure things out later because no one wanted to be left with holding the bag if those numbers were true. So, basically the market sold off as if they were true without being able to verify it and hope that in the next few days or the next few weeks that they were going to be able to then figure it out. And if it was false, they would, buy back in. If it was true, then they would have hopefully protected themselves a little bit by getting out as soon as possible. So, we've already seen NVIDIA recover a little bit here today at pre-market. Not enough to kind of to say one way or another. At the moment, there seems to be an overall consensus amongst analysts that the numbers provided from DeepSeek were unlikely to be true, that there's likely support that perhaps the Chinese government has given DeepSeek to be able to train these models on more powerful chips and give them money to be able to do so that they could, from a strategic perspective, compete with the U.S. on this front, which is by no means surprising if they did that. The U.S. is certainly trying to do that. That was the whole Project Stargate that was announced last week. The U.S. is clearly wanting to invest strategically to be a dominant force in the AI industry, and there's no reason that China wouldn't want to do the same. And this is certainly one way that they can potentially fight back to, if you will, uh, by claiming that they're able to do it at the fraction of the cost, and they really were able to sending kind of hurting kind of U.S. equity valuations. So I would say that initially it feels like the move was a bit of a knee-jerk reaction that was an overreaction. But that doesn't stop investors from being panicked yesterday morning and selling things off. So I do expect over the next couple of trading sessions, you will likely see some of the most hard hit names like Oracle, NVIDIA's Arista networks that were down, nearly 20% here, will likely see some recovery over the next couple of trading sessions. But then let's take a zoom out here for 1 second and take a look at the bigger picture and where we currently stand. And I think when you look at that, you realize that things aren't perhaps as bad as it might have seemed yesterday, where it felt like the world was falling apart with NVIDIA down 20% because everyone was invested in NVIDIA. Everyone had an NVIDIA stock. And when those types of positions unwind so quickly, it's really hard to kind of wrap your head around. So if you look at the S&P 500, like I said, on Friday, we closed back above all-time highs. And as of yesterday, we were basically back near the 50-day moving average. Now, one thing I will say is we held the 50-day moving average. We opened just below that 50-day moving average, but we managed to close well above that on good volume. So, from a volume perspective, that was a good price action to see holding that 50-day moving average. You have the NASDAQ 100, which did break below the 50-day moving average. So that is weakness here from a technology perspective. Now, here's the thing. Technology has been leading the markets for many, many months, many, many years, and over the last couple of decades. So if you put that into context, seeing a bit of an unwind from the technology space into the other sectors is not necessarily a bad thing. We've seen valuations that are pretty lofty on the technology side. You have the NASDAQ 100 trading at 27 times forward earnings versus 21, 22 on the S&P 500, right? So if you do see the NASDAQ pull back 3% and see that flow into the other sectors, that's not necessarily a bad thing per se for the health of the market. You have the Russell 2000 that did get rejected at the 50-day moving average, still trading below that. But notice how small caps was only down less than 1% here yesterday. Not such a terrible result. And more importantly, if you look at the equal weight S&P 500 index, yesterday was actually up, zero. It was basically flat. It's slightly up. But that really speaks to me that there wasn't this kind of broad market panic and concern that this was going to, shed into the next sell-off here for the overall markets, that you simply had a rotation out of the most, highly valued tech names into kind of value-based names, small cap names. And that's exactly what we saw here yesterday. So the overall picture for me, when you zoom out and take a look at where equity markets landed at the end of yesterday, it actually looks somewhat positive. What we saw was that some of the sectors that have been leading the markets pulled back, and some of the sectors that were lagging behind saw inflows. That is what we call rotation, and rotation is a healthy thing for bullish for bull markets here. So number one, we didn't invalidate the bull market from a support perspective. You do have the NASDAQ 100 below that 50-day moving average. I would like to see that reclaim those levels here over the next couple of trading sessions. If we do, when we look at it in combination of where small caps are, where the equal weight indices are, it actually does not look that weak, in my opinion, here for the overall equity markets. So that's kind of where we stand from a big picture perspective. Okay. Um, I don't know we need to spend so much time on some of the other charts here today, like commodities and things like that, because I think where we currently stand here from an equity perspective is really what most people are focused on here right now. Notice how bonds, high yield corporate bonds, have remained, positive on yesterday's move. That really speaks to the fact that the bond markets were not in any way spooked by yesterday's move or yesterday's news, still kind of providing a very risk-on environment here from the higher yield side here for bonds. You do have the VIX spiking here, but at the end of the day, after intraday getting as high as 22 and a half, settled here at the very low end of the day, around just shy of just below 18%. So we have seen an uptick in terms of expected volatility going forward, but not a big move here. 10-year yields largely unchanged, 4.5% on yesterday's move. Still, ultimately providing a bit of headwind here for equities. You saw treasuries find a little bit of a bid here yesterday, and the dollar index rallying a little bit here on the back of that news. So still back around that 108 level, which is a major resistance level that has now turned in a major support level that's now turned into resistance. You have Bitcoin pulling back here yesterday, but recovering now to around 102 thousand dollars in terms of Bitcoin. Gold pulling back from those all-time highs here around 2,800, just shy of 2,800 here to the downside, and oil continuing to plummet here. We do expect oil to continue kind of the supply side of things become more and more robust, and that's going to continue to put downside pressure here in terms of oil. But the big move here yesterday is really tech. Tech was down nearly 5% here yesterday. But notice that tech, still managed to hold on to some major support levels here to the downside. We'll see over the next couple of days if we get a bit of a bounce or if we see some further declines here in terms of tech. I wouldn't be surprised if we do see some further declines in tech, but it does feel like yesterday's move was a bit of a knee-jerk reaction. You see consumer discretionary yesterday opening up near the 50-day moving average. By the time we closed, we were back basically flat. We're actually up on the day in terms of consumer discretionary. Same thing in terms of communications. So a lot of these sectors that even though technology sold off so heavily, financials were up 1% here yesterday. Consumer staples up over 2.5% here yesterday. Uh, Healthcare up 2.25% here yesterday. And all of these sectors that were lagging behind basically saw inflows. And again, that is the positivity that I see here in equities is basically you remove some froth out of the tech names back into some of the sectors that have been lagging behind. So value, small cap, all saw inflows, materials flat on the day, industrials down nearly 1.25% here. So industrials, one of the stronger sectors here right now, saw a little bit of outflow here. And industrials have a lot of stocks that perhaps were tied to Project Stargate. We saw the inflow due to Project Stargate here last week. Started to see some perhaps unwinding there. Real estate up 1% here yesterday. That not particularly phased. Energy continues to climb, but that's based on oil prices and utilities. Down 2 and 3% here yesterday. And again, utilities also has a fair amount of exposure, at the moment to Project Stargate, and that's why we saw that sell off here yesterday alongside semiconductors. So again, overall, when you really drill down into the individual sectors and you don't see that broad-based sell-off across the sectors, instead what you saw was a pullout of kind of the sectors that had some of the highest valuations into the sectors that had some of the lowest valuations. That is a healthy mechanic of the overall markets, what we consider as sector rotation. And that sector rotation is a good thing to see for equity markets. So overall, I would say we have a market that is not nearly as concerning as what made it seem when we opened the markets here yesterday and even at the close. Now we've had some time to digest. Semiconductors down nearly 8% here yesterday. But notice how semiconductors has held some major support levels here. Big volume day yesterday. We'll see today if, let's say, we bounce off of this 210 level here on the SOX ETF. And it looks like at least when we're about to open here, that is going to happen. We already have, that ETF up slightly on the day here at the pre-market open. So let's get through the next couple of trading sessions, see how markets react here, and also if we can get some news out of, what the news out of China, the validity of the news out of China in terms of the actual cost that it took to build out DeepSeek. Um, and I think that from a consumer perspective, having a AI model that is free, that is open source, that is in theory competing with the leading models, is an overall good thing for the markets. Innovation and competition is a good thing. Generally speaking, innovation and competition has not stopped. the leading companies from spending. If you go back to thinking like about the space race, when Russia kind of put out their first satellite and beat US to it, did it stop the US from spending to continue to dominate in that particular space? No. That is an interesting parallel to draw to what we're seeing in terms of the AI space at the moment. Yeah, unless unless we find out that DeepSeek has made some significant what's the right word, breakthroughs in terms of how AI models are trained, and the US companies can adopt it and significantly reduce their capital expenditure. Probably the biggest loser here would be NVIDIA and the technology and the semiconductor companies that power all of this. But the net beneficiary of these will be the overall tech companies, because that means that they don't have to spend tens of billion dollars a year in terms of infrastructure. They might be able to get away with spending a few billion or even less than that. And that would certainly add a ton to margins. That would improve margins significantly, in 2025 and 26, which would be an overall net positive for the majority of tech companies, but it will hurt some companies like NVIDIA, Oracle, Dell, some of these companies that are, the part of the infrastructure piece of building out kind of this very, very expensive infrastructure that up until now has been required to be a leader in this particular industry. So that is my net take here on where we currently stand. I hope that that was helpful in giving you a better summary of where we currently stand. And, I was only able to do this after today. So, if we had spoken yesterday morning, I couldn't have given you all of this information. Only after yesterday's kind of price action, after digging through some of the data from yesterday, are we able to kind of reach some of these conclusions. And hopefully in the next couple of days, we'll also get a little bit more clarity. But if we can kind of validate that the numbers out of DeepSeek were perhaps a little bit a bit of a misnomer in terms of what it actually cost them to develop this, that would certainly change, I think, the outlook for NVIDIA, and this could potentially be a one hell of a buying opportunity for NVIDIA stock if, these results were a little bit overblown or overstated in terms of the actual cost that it took to build out DeepSeek. And I think the most interesting thing was that DeepSeek, it wasn't like this was news that was released over the weekend. DeepSeek was released on Monday of last week, and it took the markets nearly a full week to really kind of grasp the severity and the actual news of all of this. Usually markets don't move that slow, but I think it was interesting that even though the DeepSeek was announced last Monday, it wasn't until over the weekend until kind of everyone sort of caught on to this. And that's part of why I think this is perhaps a little bit overblown, because if it truly was uh, the type of news that was going to completely change the industry, I think that we could have perhaps figured this thing out a little quicker. It was really just the velocity of the news that came out about DeepSeek and the cost of it that kind of reached a bit of a peak over the weekend, and it sort of spooked and panicked some investors. But I think overall competition is good for you as a consumer of any type of AI tools, and certainly the continued pace of these tech companies and what they were going to have to spend to build out these AI models is completely what's the right word? Untenable in the long run, right? Considering the amount of revenue they can generate from AI is completely unproven. Uh, the leading companies right now are only making a few $100 million a year on these types of products, yet they're spending tens of billions of dollars a year. The revenue and earnings just are nowhere near what they're spending. But right now, that doesn't matter. They're just spending to dominate in terms of the space. But eventually, and investors are very much aware of this. They learned their lesson in the dot-com era. They learned their lesson in terms of pumping up companies that have little little earnings, little revenue. For the most part, that's changed, right? If you look at companies like leading in this particular space, like Nvidia, Meta, Alphabet, these are hugely profitable companies. Investing kind of their profits into this, not kind of brand new startups, with the exception of OpenAI. So I think Wall Street has learned their lesson from the dot-com boom. I certainly do not see this as another dot-com crash at all. I don't think we have any of the parallels that kind of drove the excess around the dot-com boom here, even though we can argue that AI has led to some overvalued stocks. And, yesterday's price action kind of reflects the nature of that and the fragility of that. And we'll see if this is just more of a one-day sell-off where markets kind of overreacted a little bit and effectively sold the news and said we'll figure it out after the fact. And if that's the case, I think that what we did is we took a little bit of excess out of the markets, rotated into kind of the weaker sectors, and did create a buying opportunity for some investors in some of these names. So we'll have a little more data on that here by next week to share with you. But for now, that is kind of where we stand from a macro perspective. With that, I hope that this helps you navigate, this week a little bit easier, with a little bit more confidence in terms of what to look for going forward. And I will be back here next Tuesday to help you update you on where we currently stand. With that, thank you so much. I hope you guys have a great trading day and see you guys here next week.